All right, welcome back to The Explainer. Today, we're taking one of the most iconic luxury brands on the planet and putting it through the absolute ultimate valuation gauntlet. We are looking under the hood of Ferrari, trading under the ticker RACE, using their fresh Q1 2026 data. But we aren't just doing a standard run-of-the-mill earnings review today. We're actually going to step into the shoes of legendary investors. We're talking Warren Buffett, Peter Lynch, Benjamin Graham. We'll apply their exact frameworks to this stock and then wrap the whole thing up with some rigorous discounted cash flow and dividend discount models. Okay, let's dive right into this. Here is our track map for today's analysis. We'll kick things off with a quick company snapshot, run the data through our three guru lenses, crunch the hard math with a DCF, and finally synthesize a solid recommendation. Starting with Section 1, the company's snapshot. Let's start the engine and look at Ferrari's baseline performance as of Q1 2026. Honestly, no matter what macro conditions are doing out there, Ferrari is literally firing on all cylinders. Looking at the official Q1 release, you'll see net revenues hit 1.84 billion euros. That's a solid 3% increase year over year, or actually make that 6% if we adjust for constant currency. They're effortlessly delivering highly anticipated models like the Pro Cinque and the new 12 Cilindri family, all while managing a massive transition. But here is the absolutely crucial point, the profitability. We're looking at an incredible EBITDA, or operating profit margin, of nearly 30%, 29.7 to be exact. Net profit is sitting comfortably at 413 million euros, which gives us a diluted earnings per share of 2.33 euros for the quarter. And, perhaps most importantly for the valuation models we're about to build, they generated a staggering 653 million euros in industrial free cash flow. That's up 5% from last year. This business model shows extreme resilience. I mean, they're practically printing cash. Moving to Section 2, let's run Ferrari through our very first rigorous test, the Warren Buffett lens. How exactly would the Oracle of Omaha view the prancing horse? Well, as you probably know, Buffett's entire philosophy begins with an impenetrable economic moat. He wants something that protects market share and gives a company undeniable pricing power. And Ferrari's brand exclusivity, it is arguably the strongest moat in the automotive world, maybe even the entire luxury world. CEO Benedetto Vigna noted in the Q1 report that their order book already extends out toward the end of 2027. That kind of visibility, that extreme pricing power, is exactly what Buffett drools over. So, checking off Buffett's specific criteria: moat, exceptional; management, highly solid. They just confidently confirmed their 2026 guidance. Debt, extremely manageable. Actually, as of March 31st, they hold a net industrial cash position of 388 million euros, completely reversing their net debt position from the end of 2025. And earnings are incredibly consistent. So, qualitatively speaking, Ferrari easily passes Buffett's test. But we know Buffett. He demands a margin of safety, and he bases that on what he calls owner earnings. If we take that Q1 industrial free cash flow of 653 million euros as our proxy for owner earnings and just annualize it, we find Ferrari generates a massive 2.61 billion euros a year. It's a huge number, right? But because Buffett typically demands a steep market correction to secure his mandatory margin of safety, and considering the premium this stock trades at, he'd likely be sitting on his hands, waiting for a major pullback before buying in. All right, Section 3. Shifting gears entirely, let's apply the Peter Lynch lens to see how this stock behaves in the wild. To use Lynch's methodology, the very first thing we have to do is categorize the company. Are they a slow grower, a stalwart, a fast grower, a cyclical, a turnaround, or an asset play? Getting this categorization right is essential because it dictates exactly how we value the stock. When you look at their massive market cap, their incredibly rich mix of personalizations, and that steady, reliable 3% revenue growth, Ferrari perfectly fits Lynch's stalwart category. Stalwarts are great because they offer downside protection. We literally see this in their resilient delivery numbers despite ongoing geopolitical headwinds. But as a stalwart, they aren't going to give you those crazy 50% year-over-year hypergrowth numbers. So for a stalwart, the key metric for Lynch is the PEG ratio, price to earnings divided by growth. Now, our source documents focus heavily on the raw financials rather than a current ticker price. So to run the map, let's assume a market price of 390 euros based on its recent historical trading range. If we annualize that 2.33 euro Q1 EPS, we get 9.32 euros for the year. That gives us a PE of roughly 41.8. Then, if we generously assume a 10% earnings growth rate based on their strong margins, the PEG ratio lands at a lofty 4.18. For Lynch, Anything over 1 is getting pricey, and over 2 is a flashing red warning sign. So under the Lynch lens, this stalwart is likely a strict hold or even a sell, entirely due to that steep valuation. Moving into Section 4, next, we bring Ferrari into the inspection pit for the Benjamin Graham lens, the father of value investing himself. And spoiler alert, this is the most conservative test of all. First up is Graham's famous defensive checklist. Ferrari easily passes on adequate size. They're projecting 7.5 billion euros in 2026 revenues. They pass on strong financials with that net cash positive position. Earnings stability? Pass. And dividend record? An absolute pass. In fact, they just approved a massive 640 million euro distribution to shareholders, which equates to 3.615 euros per share. However, Graham is notoriously, famously strict on price. His intrinsic value formula multiplies the square root of 22.5 by the EPS and then by the book value per share. So assuming a conservative book value of 20 euros based on their historical balance sheet to fill our DOTA gap, we run the formula with our 9.32 euro annualized EPS. The output? An intrinsic value of just 64.76 euros per share. So at our assumed price of 390, the ultimate value investor wouldn't touch the stock without a colossal, 80% price crash. That's what he needs to create that seatbelt-like margin of safety. Section 5. Okay, stepping away from the gurus for a minute, let's roll up our sleeves and run the hard math ourselves using a discounted cash flow and alternative models. Let's run a DCF sensitivity table, kind of like a wind tunnel test for the stock. We forecast this based on that 2.6 billion euro annualized free cash flow we found earlier. If we assume a very reasonable 8% weighted average cost of capital, which is essentially what it costs the company to fund itself, and a 3% perpetual growth rate into the terminal value, our base case DCF yields a fair value of around 280 euros per share. Sure, if we adjust the WACC down or the growth up, that value climbs, but 280 represents a very solid, mathematically grounded baseline. To cross-check that, let's use the dividend discount model, or DDM, as our alternative approach. We take that officially confirmed 3.615 euros per share dividend. If we assume an 8% cost of equity and a 6.5% dividend growth rate, we generate a slightly lower DDM fair value of 241 euros. Both the DCF and the DDM point to intrinsic values that are significantly lower than current market assumptions. It just goes to show you the massive premium investors are willing to pay for this brand. Section 6. It's time to cross the finish line. Let's synthesize all of these distinct models into one final, cohesive investment thesis. When you line up the fair value range across all these methodologies side by side, it is incredibly revealing. You've got Graham's hyper-conservative 65 euros, the DDM at 241, the DCF at 280, all the way up to an assumed market price near 390. It is abundantly clear that while Ferrari's fundamentals, their cash flow, and their moat are absolutely flawless, the market is currently pricing in a huge premium for the predictability and exclusivity of the brand. So, blending all these insights, what is our final verdict? Well, the strengths are undeniable, right? An unmatched moat, a 39.1% EBITDA margin, and a fortress balance sheet with net cash. The risks, they are entirely valuation-based. We're talking a high PEG ratio, WACC sensitivity, and zero margin of safety for strict value investors. Our recommendation based on the data is a hold at current levels for existing owners. However, it becomes a screaming buy based on the DCF model if macroeconomic conditions pull the stock price down below that 280 euro fair value level. Given the undeniable power of Ferrari's economic moat, their stunning profitability, and that highly premium price tag we just calculated across multiple models, we have to ask you, at what valuation would you finally feel comfortable taking this stock for a spin? Think about your own margin of safety, and we'll see you in the next explainer.